The broadcast is now starting. All attendees are in listen-only mode.
Hello everyone, and welcome to the September webinar titled Roadmap Towards Retirement, courtesy of the Principal Financial Group. We certainly appreciate all of you taking the time to join us today. This webinar is part of our ongoing monthly webinar series, and today we will discuss how you can determine if you are saving enough, how to review your investment choices, and how to stay on track for retirement. A few housekeeping items before we get started. First, please note that in order to ensure everyone has the ability to hear the information presented by our guest speaker, everyone will be on mute during the webinar. During the presentation, feel free to write in any questions you have using the Q&A link on the webinar menu. Then at the end of the presentation, we'll take some time to go through these. With that said, I'd like to introduce our guest speaker from the from the Principal, Stefan Sandoval, Account Executive for the Principal Financial Group. Stefan is a certified financial planner professional, having been in investments for 7 years and financial banking for 10 years. He is an active member of Toastmasters International, a group dedicated to the improvement of public speaking. He also is an active participant of the Los Angeles World Affairs Council and the Harvard Business School Association of Orange County. Stefan joined the Principal Financial Group in 2010 as Southern California's newest account executive. We're very excited to have Stefan here to share some insight on saving for retirement. I'd really like to thank Stefan for taking the time to get on this call with us. With that said, Stefan, I'll now turn it over to you.
Thank you very much, and thank you all for attending this session, Roadmap Toward Retirement. What you see on your screen is going to be the basics of what we're going to be going through with your plan here, but not everything is going to be on this PowerPoint presentation per se. Many of you do have an enrollment book or have some more information there in front of you. But you can also go onto our website at principal.com to receive more information on the different topics that we're going to be talking about here. And so we're going to talk about three things specifically. We're going to talk about how to determine whether you're saving enough for retirement. We'll briefly discuss investment options, your choices, and how to determine whether you're properly diversified or not, and then how you should stay on track when it comes to your retirement plan. So first step, determining whether you're saving or not, is a very ambiguous question because, well, every person's going to be different. There's a lot of things that are going to be needed to take into consideration. First of all is how many years do you have before retirement? A person who's 25 years old may not have to save as much as a person who's 65 years old. Second thing is how much has already been saved. Someone who's young and has saved perhaps, say, $500,000 may not have to do as much as a person who's just starting out. And then finally, where do you plan on living? Because the cost of living here in Southern California, as an example, is a lot more expensive than living in Des Moines, Iowa. So those are different factors that need to be taken into consideration, something that you need to be aware of. Also, look at your plan specifically. Each plan has different provisions. Some will allow you to do save up to a certain percentage amount. Others have different deferral rates. So keep that in mind when you're looking at your company plan's retirement. As far as I'm aware, there are different employees on this line here, so that's something to be aware of. Also, don't forget, whatever amount that you're putting away into your retirement plan, your retirement plan here specifically, it goes on a before-tax basis. This is probably one of the best ways your CPA will tell you you can save and defer or postpone money for the future. And so if you're making, say, for an example, $30,000 a year, and you're putting away 10% of your income, which is $3,000, at the end of the year, you're not going to pay taxes on $30,000. You're going to be paying taxes on the $27,000, which can potentially lower your income tax bracket. Don't forget that taxes here in the United States are progressive. The more money a person makes, the more they pay in taxes, the higher their tax bracket can become. But when you put away into your 401k plan or your retirement plan, it can lower what your taxable income is at the end of the year. And this is where the potential growth can come from. One of the main reasons why when you meet up with your CPA at the end of the year, they say take full advantage of your tax-deferred growth and put away into your retirement plan. Because you can also have compounding interest earning in that plan. Not only are you potentially lowering your tax bracket for every year, which can reduce your taxes, But any earnings in your retirement plan is also growing on a tax-deferred basis. Remember, not tax-free. One of the questions I have asked periodically is, when is this money going to be tax-free? And the answer is never. There are two things sure in life, death and taxes. So you will eventually have to pay taxes in your retirement plan. A lot of people confuse the penalty with the taxes, which sounds synonymous for me. But if you withdraw this money before the age of 59 and a half, there is a 10% penalty in addition to the taxes you will have to pay. After the age of 59 and a half, that 10% penalty goes away. But the taxes, well, the taxes remain forever. So that's what I mean. You'll always pay taxes. It's the penalty that can go away after the age of 59 and a half. So you may say, well, then what's the benefit of putting away into this retirement plan if I'm going to have to pay taxes eventually? Well, don't forget that the money is growing tax-deferred. You're earning interest on your interest, but you're also earning interest on that extra 20 to 25% that would have otherwise gone to Uncle Sam every single year. This is where the power of compounding interest can come from. So instead of earning 20% less in return every single year, and that money going to Uncle Sam in a regular savings account, those earnings are going to you. And they're working for you for the next 5 years, the next 10 years, the next 30 years in your retirement plan. This slide here, this matrix that you see in front of your screen, shows you what the impact on your take-home pay would be. So for example, if you are earning $40,000 a year, and you're considering putting away an extra 2% of your income, well, that's going to lower your take-home pay by only $23 on a biweekly basis. That's 26 times a year. Weekly, that's about $11.50. And so we're looking at a savings of a little under $2 a day. And so the point is to try to figure out, how can I save about $2 a day so I can have a little bit of more money for my future? Here, let me give you an example. We have two people here. We have Elaine and we have Philip. Now here, they're both earning $35,000 a year, and they're both 25 years away from retirement. Now they both begin by putting away 8% of their income to their retirement plan. But Elaine does something different. She puts away an extra 1% a year for the next 5 years, meaning this year she starts off with 8%. Next year she increases it by 1%. So instead of staying with 8%, she goes up to 9. The next year she goes to 10. And so on and so forth until she reaches her goal of 13% after 5 years. And then she stays there. Philip, on the other hand, he stays at the 8% and never increases what he's putting away. Now, you can see that the total contribution in 25 years is only a difference of, gosh, it's really early in the morning for me. Is that $70,000? Elaine put away $185,000. Philip put away $116,000. But if you look at to the right, you can see that the dollar difference that made is a difference of over $170,000. I don't know about you, but I like to have an extra $170,000 for retirement. And the easiest way to do that is simply by increasing what you're putting away by 1% per year. And the rule of thumb is for every $1,000 that you make before taxes, 1% is $10. So if you make $2,000 every paycheck and you increase what you're putting away by 1%, well, that's just an extra $20 per paycheck that's going away. But you can see in the long run, it really does make a big difference. You know, in my years of helping people for their retirement plan, I have never had anyone say they made a mistake of putting away too much money for their future. I'm still waiting for the day somebody points their finger and say, it's your fault I've saved $1 million. What am I going to do with all this money? No, it has not happened yet. But I have had many people confide in me and say if only they made the mistake, if you can even call it that, of putting away more money rather than less for their future. So again, you'll never make the mistake of putting away too much money for your future. Here, this chart assumes if you're making $35,000 a year, what your potential growth would be depending on what amount you would contribute to your plan. So if, say, for example, you are contributing 8% of your income, for the next 20 years, you can see that's going to be a return of $180,000. Now, this chart here, a lot of people do say, well, what's the assumed rate of return on there? Well, you can see it's an assumed rate of return of about 8%. And before you even ask, I'll go ahead and answer that question. A lot of people say, well, 8%, don't you think that's a little too high? I mean, from what I've heard, there's really nothing out there that's making 8%. Well, this is, we're being very conservative with that return. If we look at the U.S. economy, and I'm talking about the S&P 500 in this instance, if you look at it for the past 50 years, from 1962 to 2011, the market has actually averaged 9.7%. 9.7%. Think about that, because during those past 50 years, there have been a lot of reasons that you, quote unquote, should not have invested in the market. Let's go back in time, November 23rd, 1963, the assassination of John F. Kennedy, probably one of the worst times to have invested in the market. Then you had the Vietnam War, followed by the 1974-1975 oil embargo crisis, and you had stagflation at the time. You also had Chernobyl, 3 Mile Island, 2 nuclear disasters. You had a great earthquake in Mexico City. Does any of this sound familiar to what happened in Japan just last year? You had the savings and loans crisis of the early 80s. You had 1987, in one day, we call it Black Tuesday, the market fell by over 26% in just one day. You had the dot-com bust of 2000. You had the Great Recession, where the market from its high to its low lost over 50%. And despite all of those reasons, the market has averaged 9.7% over the past 50 years. And so when we're using 8%, we're actually being very conservative, looking at the true historic returns on the market for the past 50 years. So also don't forget, putting away money into your retirement plan does require a budget. You do have to plan for this. One of the mistakes a lot of people make when it comes to planning for their future is they say, well, this is what I'll do. I'll take my paycheck, I'll pay my bills first, and then whatever left over I'm going to save. And unfortunately, when a lot of people take that school of thought, there usually isn't anything left over at the end of the day. Putting away money into your 401k, because it goes through payroll, meaning you get to pay yourself first before you pay anything else. And so a lot of people, they'll still say that. They'll still say, I'll pay the bills, and then whatever is left over, I'll save. And of course, at the end of the day, there's nothing saved except the fact that they've tricked themselves and they put away money into their retirement plan before they paid any other bills. So this is one of the best benefits of participating in your company's retirement plan. Step 2, reviewing your investment choices. Now, I don't know what your options are in your plan, but there are some basic rules of thumb that make sense no matter what investments are available in your plan. The first one is diversify. You've all heard the phrase, don't put all your eggs in one basket. Make sure that you have a little bit of everything in each separate category. Speaking of diversification, I've had one person say, well, when I put my money in one mutual fund, am I not diversified? And the answer can be yes, but it could also be no. If you have all your money in one mutual fund, and a mutual fund is simply a collection of different stocks, bonds, and different investment options within there. But sometimes mutual funds are diversified according to one particular industry. Let's say, for example, the financial industry. So yes, your money is diversified in Bank of America stock, Wells Fargo stock, UBS stock, but the problem is you're all in financial services. And if we have 2008 happen all over again when all the financial industries were hammered, well, you weren't properly diversified. So what I mean by diversification is putting your money in different sectors, some in financial, some in technology, some in international. That way you're not only diversified geographically, but you're also diversified in terms of what industries your money is in. Second is rebalancing. Look, if I had my money in 2 different investment options, let's call them A and B, 50% in each. And the market after 1 year made it where Fund A was 80% of my portfolio and Fund B was only 20% of my portfolio. Well, when I originally started, I wanted it 50%. And perhaps I'm listening to the news and the news is telling me my stock A, where I have 80% of my money, is going to do exceptionally well this year. The second stock is not going to do so well. While I may be inclined to sell stock B or Fund B and put more money into Fund A. The mistake I have made, which a lot of people do make even though they know the rule, is that I have sold low and I have bought high when I should have sold high and bought low. Rebalancing will require you to sell at the high, buy at the low to bring you back at a 50% balance between your two funds, or whatever percentages that you have chosen. And this is recommended to be done either on a quarterly or on an annual basis. And at Principal Financial Group, we do have those tools made available where we can rebalance your portfolio on an automatic basis, either every quarter or every year. Also keep in mind that there is inflationary risk. Even if you were to decide to put all your money in the money market account or the savings account, you do run the risk of inflation, which nationally has averaged 3% over the past 70 years. Depending on where you live geographically, of course, that inflationary percentage can be a lot higher. I know in Southern California, it's definitely higher than 3%, so keep that in mind. Here we have what would happen if you were to try to time the market. And you can see if you've missed the 50 on top there, is if you missed the 50 best days in the market over the past, from 1991 to 2010, you would have actually been negative 2%. Now, I'm not going to go through all of them, but look at the very last one. If you stayed in the market, your average return would have actually been 9.2%. This is over the past 20 years there. What's the moral of this story? Remember that it's time in the market, not timing the market, that's the most important thing when it comes to investing. Nobody knows what's going to be happening in the future. So the best rule of thumb is to just go ahead and ride the wave. Here, take a look. This is how the market has been doing for the past 20 years. I'll give it a few seconds here. There we go. This is how the market has been doing for the past 20 years. From 1991 to 2010. Now the top is the absolute best place you could have had your money invested. And the bottom, the absolute worst place. Now each color represents a different segment in the market. And the mistake a lot of people make is they do two things. They do one, put all their money in one place, and two, they usually put it in what did great the year before. Now let's say, for example, this is the year 1992. And we're trying to figure out where we should have our money invested. A lot of people would look at 1991 and say, wow, look at the best one in 1991. It did 51% return. I think I'm going to put all my money in there because if it did 50% last year, I'm pretty sure it'll do well this year. There's got to be something right about this fund. Well, take a look at what happens for the next 20 years. What you can see is that there is no rhyme or reason. You can pick any color, actually, on here, and you're going to realize you're all over the board. In fact, you were never on top again until 1999, and thereafter 2 more times over the course of 20 years. You do see that you spent quite some time in the bottom, too. I will tell you this, after the year 2008, a lot of people have told me that there really is a price to pay to being able to sleep at night. Here's a better approach. Now, that white box there is a diversified portfolio, a little bit of everything. Now, diversifying does not mean you'll make money every single year. In fact, you can tell you've never actually been on top. But also, you've never been on the bottom either. Diversifying your money helps to ensure that you have a steady, sustainable growth. Because if your school of thought is to invest your money in what did great the year before, I can guarantee that you're always going to be 1 year too late. It's like driving a car always looking at the rear view mirror. It's great that you know what's past you. You're just going to miss that tree that's in front of you. Now, I don't know what's going to happen in the future. My crystal ball has broke as well. It might be broken. But what I do know is the way to mitigate my losses is to make sure that I have a little bit of everything. So finally, we'll talk about staying on track. Again, you want to pay yourself first, and by doing that is by contributing to your retirement plan. This is done on a before tax basis, not growing tax-free, simply growing tax-deferred. Do revisit your contributions and your investment elections, because from time to time, your risk tolerance may change. You may have started investing at the age of 25 as an aggressive investor. Well, here we are 30 years later, and you've never changed your risk tolerance. Now, if you realize that you can't sleep at night because you're worried about what's happening with your retirement plan, that may be a good time to revisit your plan and perhaps change your risk tolerance. And don't forget, there are different risk tolerances. Putting your money in the market does not mean having your money in an aggressive portfolio. You can have it in a conservative portfolio, a conservative moderate, moderate aggressive, or aggressive. There are 5 different risk tolerance categories to choose from. And also, you are not alone. We're not going to leave you as orphans here. You can always call Principal Financial Group, and we can help you with different tools that can, one, help determine your risk tolerance, and to help rebalance your portfolio as well. Also, don't forget that life can happen. Make sure you update your beneficiary, and if you've never designated a beneficiary, this is perhaps a good time to do that. As a reminder, if you are single, and single includes widowed, divorced, or legally separated, and I emphasize legally separated, you can name anyone you want as your beneficiary. If you are married or have recently been married, perhaps you're separated but not legally separated. Many people ask, what's that definition? Well, that's a good time to talk to a lawyer. But again, if you are married or separated but not legally, or have recently been married, you must name your spouse as your 100% sole and only beneficiary. If, however, you have children from a previous marriage and you do not want them disinherited, or perhaps you want to leave something to your mother and you don't want her to be left destitute, you could name someone else. However, your spouse must sign waiving their rights in front of a public notary, whether it's only 1% or 100% of your beneficiary form. Your spouse must sign in front of a public notary, so keep that in mind there. Your beneficiary can be changed at any time, and if it needs to be updated, perhaps you've been recently divorced or widowed, this is a good time to reconsider that plan. We do have some disclosures there. One way to stay connected with the Principal Financial Group, you can either like us on Facebook or follow us on Twitter. We're also on LinkedIn. You can also go to our website directly at principal.com, and we have a smartphone application where you can get the most up-to-date balances of your portfolio. But you can also receive weekly updates. I receive a text message every Friday telling me how I did for the week. One of the benefits of that is, rather than only looking at my retirement plan, say, every quarter or 4 times per year, now I look at it 52 times per year, which keeps me up to date, which keeps me mindful of my retirement plan. It helps me think about it and realize what different things can I do to ensure that I'm doing the best for my future. Here you have our telephone number as well. If you have any questions, you can always either call Pensionmark there, and we do have bilingual licensed representatives that can help you. And bilingual, I'm assuming it's going to be in Spanish, English or Spanish. So if you're working on your Spanish, there's a telephone number that can help you out there. And with that said, I'll go ahead and open up to any questions that you may have in regards to your plan. Anything in general.
Thank you, Stefan. We'll now start addressing some of the questions that have been coming in. Please remember that if you have any questions, you can submit them through the Q&A tool on the webinar menu. As always, for any plan-specific questions, you can also reach out to your dedicated service team here at Pensionmark. And as we wait for some questions to filter in, I just want to let everyone know that Pensionmark is also now on social media. So if you'd like to keep up to date on news and events that are important for you saving for retirement, please like us on Facebook, follow us on Twitter, and connect with us on LinkedIn. And we'll just give a minute or two for some questions to filter in.
Sure.
All right, Stefan, just a couple questions. Could you expand more on the inflationary risk in investing in a money market or stable value fund?
Sure. Okay. A money market account or a savings account, I have one at Bank of America, and I've been averaging 0.05% there. Meaning for every $100 that I have invested, I'm making about 5 pennies a year. Not really a whole lot. However, when I take inflation into consideration or the cost of living, I'm actually losing. If we take the national rate of inflation, which is at 3%, this means that what I could buy with $100 today, I have to pay $103 in 1 year. And of course, if I'm only making 0.05% on each $100, I'm actually negative $295. This is inflationary risk. So even though it feels like my principal is intact, my purchasing power is actually being lost every single year. This is the problem with inflationary risk. This is the problem with investing everything in a savings account. Remember, a savings account is there to save money. It's not there to invest. What do I mean by that? Well, a savings account is to ensure that if I have $100 today, I'm going to have $100 tomorrow. An investment account ensures that if I have $100 today, I'm hoping to have more than $100 in 1 year or 5 years or 10 years from now. I don't want to say it's the rule, but the goal is to try to make more than what's being lost to inflation. And that will never happen when it comes to a money market account or a savings account.
Great, thank you. We've had a couple questions come in regarding Roth deferrals. Could you talk about the benefits of someone saving with a Roth deferral as opposed to a pre-tax? What are some of the pros and cons?
Sure. Okay. Roth is a very good liable option when it comes to a retirement plan. So let's go back and let's talk about the traditional retirement plan. Any money I put away in a traditional plan, let's take a 25-year-old into consideration. A 25-year-old who is going to be saving for retirement at the age of 65. And if this person puts away $100 per month, after 1 year, they put away a total of $1,200. After 10 years, they put away a total of $12,000. After 40 years, by the time they retire, they put away about $48,000. And that $48,000 can grow to be $900,000, considering how the stock market has done over the course of 50 years. So in a traditional plan, this 25-year-old, let's call him Bob, has put away a total of $48,000 of his income. That income he's been able to defer, meaning he's been able to decrease his taxable income by $1,200 every single year, or $48,000 he hasn't paid. And so the full $900,000 has been growing tax deferred. Now he's 65 years old and he's ready to retire. That $900,000 is all taxable, all of it, completely taxable. All at one time? No. It's only taxed on whatever he pulls out. So if he pulls it all out in 1 year, now he's going to pay taxes on that $900,000. That's definitely going to increase his taxable income bracket. However, he says, no, I only need $5,000 this year. Well, he can withdraw $5,000 and only pay taxes on the $5,000. The other $895,000 continues to grow tax deferred. So in the traditional plan, the money grows tax deferred. When you retire, it's taxable. In your Roth option, it works in the opposite direction. Bob has not received any tax break. So every single time he has put in $100, he's had to pay taxes on that $100. It wasn't growing tax deferred. It's been growing taxed. So over the course of 40 years, he's paid the taxes on his $48,000, never got a tax break. Now he has a balance of $900,000. That $900,000 is tax-free. Not just the $48,000 he put away, but the full $900,000 is tax-free. Now, be aware, he's paid taxes on the $48,000, and the $900,000 is tax-free. Not just what he pulls out, but the entire amount. So if he decided, I'm going to pull out the full $900,000 at age 65, that full $900,000 is tax-free. So going back, in the traditional plan, your $48,000 has been tax deferred. In your Roth, your $48,000 has been taxed. In your traditional plan, your balance of $900,000 is taxable. In your Roth plan, your $900,000 is tax-free. So you just have to ask yourself, is it better to pay taxes on $48,000 or $900,000? And if you say, well, it obviously makes sense, let's pay taxes on only $48,000, then a Roth option may be best for you. And the rule of thumb is the younger you are, the better the Roth option can be. The closer you are to retirement, meaning if you're 5 to 7 years away from retirement, the better the Roth or the traditional plan may be for you. This is, again, another good conversation to have with your tax consultant, because he may very well say both can be a viable option, but the recommendation would be to put in this percentage and maximize as much as you can into your traditional plan so you can take advantage of the Roth. I hope that makes sense.
Great, thank you. In the essence of time, I think we'll wrap up with this final question. Stefan, what are some things someone can do who may not necessarily be on track for retirement now, but is nearing retirement in the next 10 to 20 years?
That's a good question. And just to let you know, the statistics have shown that the average person starts to put away into their or starts to really consider putting away into their retirement plan at the age of 55. And so so it sounds like you're right around that age there. There are a lot of things that you can take into consideration. Obviously, the number one thing will be your retirement plan, and start putting away on a tax-deferred basis. We do have some budgeting plans online on our website. So when you go to principal.com, you can do a search on our site and put for budget. And we have some software either on our system, and also you can use, say, Quicken or Money. Some great software systems that can help you build a budget where you can start finding out, one, where your money is going on a monthly basis, and two, how you can perhaps change that around so you can start saving into your retirement plan. I bought Quicken just a couple of years ago, and I've just been amazed at how much money actually goes out to entertainment. And believe it or not, most Americans' income, a large majority, goes out for entertainment. Now, I'm not saying you can't go and go to the movies or go to sports events or different venues like that, but there are also many alternatives to choose from rather than having that. One of my participants before said, rather than going to the movie theaters every weekend, we rent at Redbox. That's great, and which is great because you're still entertaining yourself and still looking at different I should say different movies on there. So that's just one of the things that you can do. Another one that a person gave me, which I thought was great, was that they actually have a sticker on their favorite credit card, and that sticker is simply a reminder to tell them what they can do to save 10% that day. As somebody always says, if you can save 10% each day, you're actually increasing your income by that 10%. And I've tried it out, and actually I've had cashiers at Costco and at Target say, what's that sticker for? And when I explain what it means, they actually look at me and say, well, do you really need everything that you're purchasing today? And so they actually help me out, save some money for the future. But here's the thing. If you save yourself $100 with one hand, you need to ensure that you're putting that money away somewhere else, because if you save it with your right hand, you may very well spend it with the left hand. So whatever budgeting you're planning on doing, whatever savings you're going to do, the best approach is to automatically increase what you're putting away by 2% or 3% into your retirement plan. Otherwise, that saving goes to naught, because it's just going to go away at the end of the day. That's really the best thing that can be done. And of course, again, I reiterate, please take a look at the budgeting plans that are available on Principal's website.
Great. Thank you, Stefan. That will conclude our question and answer period. If anyone has any additional questions, please feel free to reach out to your dedicated service team here at Pensionmark. I'd like to thank you all for joining us today. And once again, Stefan, I'd like to thank you for taking the time to present.
Thank you.
This now concludes our webinar. Thank you.